if the Fed does come off too aggressively on rates, they're going to just bring that boogeyman inflation right back onto center stage and create a even more distasteful situation for the common man and woman. And at the end of the day, whether we're talking about politicians or hubris-laden Federal Reserve governors or academics, it's all about politics, basically, and it's all about popular opinion. And if the choice is to let the stock market fall or have riots in the street because people can't afford food and shelter, you betcha at the end of the day that the riots in the streets are going to try to be avoided if even they can.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. We're here today talking with the guys from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I thought today I would do just a dedicated drill down with the guys from New Harbor because a lot of things that are starting to move in the markets that have got both investors' attention, but I'm also hearing increasingly from followers of this program some pointed worries that they're reaching out to me with. And so I'm joined here as usual by John Lodra and Mike Preston, the lead partners there at New Harbor Financial. How you doing, guys?
Hey there, Adam. How are you today? Great to be with you, and really excited to talk about what we're seeing.
Hey, Adam, good to see you and excited to talk.
Good. And guys, like I said, I'm hearing some of these distinct questions from folks around how they should be navigating what they feel is lying ahead in the road. And we're going to talk about some of the kind of breaking data that's happening in the markets this week. But some of these other questions they're bigger than that. And just to give a quick preview, a big one is, hey, I'm looking at the cost of living and how much it's increased since COVID and how much it's still increasing year over year. People are still seeing double-digit annual increases in a lot of the essentials for living. And they're saying, I'm beginning to get concerned that going forward, the cost of living is going to rise faster than my portfolio. And therefore that on a real basis, my real net wealth, my real net worth is going to be shrinking, not growing despite my best efforts going forward. So we've got that question, plus a number of other ones that are similar, where people are just looking for guidance on, hey, if I'm worried about this, what are some strategies I can pursue? But on the week we're talking here, guys, I think there's three big things that I think the market is waking up to. One, just before we turn the cameras on here, the new job openings report came out, the JOLTS report, and it was a big miss. It was a big disappointment versus expectations. And not only was these are the July numbers, not only were the July numbers a miss, but the June numbers, which were a beat, were revised downwards, and they were revised downwards so far that compared to expectations back in June, they were a miss. So the revisions turned the June numbers from a beat into a miss, and now we have a July miss. This is sort of, I think we can really call it a trend, where we're seeing increased weakness in the labor market, more so than I think the market was anticipating. Because up until very recently, the adjectives that we heard being used to describe the job market was surprisingly resilient, strong, et cetera. What we're seeing here isn't, it's not catastrophe by any stretch, and unemployment is still relatively low. But we're really swiftly seeing that not only is the labor market normalizing, it's actually looking, I think, starting to look sick. And the question is, I think, how sick is this labor market going to be, and what are the implications of that going to be? We've talked in the past about how important the labor market is as a bulwark against recession. And that's really been, I think maybe the principal thing that kept us out of recession in 2023, where everybody expected we were going to have one, is that employment really hung in there. This is Michael Cantro's famous HOPE framework. Employment is the E in the HOPE framework. And he's long said, as have many others, that once that domino starts to tumble, then it really kind of becomes game on for the potential for a recession. So I guess the first question is investors are really starting to ask themselves, hey, wait a minute, is the dam breaking here? Is this last bulwark beginning to fall? And does that open up the fact, or does it open up the probability that this economy could fall into recession going forward from here? breaking the narrative that, oh no, we're in a no landing, soft landing scenario. John, why don't we start with you?
Yeah, Adam, it's a great topic. We often make the case, and empirical history bears this out, that markets and the economy aren't really linked in the short term. In fact, they can do dramatically different things in the very short term. So we try not to anticipate economic readings and what that means in the here and now of markets. And in fact, if you look over history, markets are very poor indicators of a recession and things like that. They're always best right before they're bad, right? So we certainly want to tune into the nearer term market signals. But the things like so the Federal Reserve, everybody's anxiously, maybe eagerly for some, awaiting their September 18th meeting, the next meeting at which they'll talk about interest rate policy, and it's all but a given. In fact, almost verbatim from Fed Chair Powell's mouth, there will be a cut in September. So the market is essentially priced in 100% probability of some degree of cutting. That's old news. That's not news anymore. The debate now is will they drop 25 basis points or 50 basis points? And for those that aren't familiar, basis points are 1/100th of a percent. So a 25 basis point drop is a 0.25% drop. So far the JOLTS readings that came out, they paint a deteriorating picture of the job market. Certainly the Fed's focus has shifted from inflation to the job market. They've been very vocal about that. They've maybe been a little bit shy of declaring total victory over inflation, but their messaging and their minutes and the meetings has certainly been focused on something other than inflation. That something other is the job market. The JOLTS numbers that came out today basically paint a picture that the labor market on some of these measures is back to kind of normalized levels pre-pandemic. We had a huge shock to the labor market and all this kind of stuff, and the stimulus and all the stuff that really distorted everything, including the labor market. We're now at readings that resemble pre-pandemic, so kind of back to normal, so to speak, but deteriorating. That's an important thing, because once this momentum starts, it typically will accelerate. If you look at if you overlaid the unemployment rate, for example, over a long term period and shaded the areas that are recession, at the beginning of recessions, there's usually a little curve up in the unemployment rate, and then boom, it shoots higher, all during the midst of a recession. So bringing it back to the Fed meeting that's coming up, there's not a huge reaction so far. So let me share. This is something we look at often here, the CME FedWatch tools, and this is just the market's implied probability of different rate levels. So this is for the September meeting, and basically, here's today. The dark blue is today. There's a 57% chance implied by the market that the Fed will drop 1/4%. And as of today, a 43% chance that they'll drop 2/4% drops. That's only up slightly from yesterday. Yesterday's reading was 38% for a 50 basis point drop. Today it's up to 43. Minor increase. So the jobs data that came out hasn't dramatically moved the rate cut expectations, but notice where these were not even a month ago, about a month ago, actually 1 month ago. Right. It actually got to as high as over 80%. So there was at one point early August, I think on August 5th, when the market was in a free fall of sorts, the probability got to over 80%.
And John, that was also when the SOM rule got triggered, right?
Yep, exactly.
Which is unemployment based, right?
Yeah, so I think the September meeting, in terms of the actual, whether it's 25 basis points, 50s, is kind of going to be a nothing burger, because it's essentially 50-50 odds right now priced by the market. What I think is more important is what the future trajectory likely holds, and what the messaging coming out of September holds. Because this is if I could focus on this is a probability distribution going out to future meetings all the way out to September of next year. And these are the rate levels here. Current rate is 5.25 to 5.5. So here's the 57% we just looked at the September meeting, 43% for 50 basis point drop. But if you look at through the end of the year, there's basically 1, 2, 3, 4 cuts priced in by the December meeting. And then by next July, not even a year from now, there's a full 2 percentage points of interest rate drops priced in or expected by the market. I think that's where maybe some surprises can come, because that certainly is a more pronounced rate cut trajectory than we've seen at any time in the last couple of years, or last year anyways. And I think there's a chance that the market gets disappointed there because certainly if the Fed, for example, comes out in September and walks that back a little bit. Point being is we are at literally a breath away from all-time highs in the U.S. stock market. And maybe we're simple-minded, but a fully valued, more overvalued market in history doesn't jive with two percentage of rate cuts, which would likely only happen in the face of material economic weakness and job market losses, things like that. So we think the stock market ultimately has a reckoning, and we'll certainly, I'm sure, talk quite a bit about that.
Okay, yeah, and that's what you just showed is a great segue into my second talking point. But before we get there, I do want to sort of address the sense of, yeah, like, again, why is the Fed cutting here when we have, I mean, we are talking about weakness that we're seeing in the jobs market, but again, it's not calamity, right? Unemployment is still, still at what, 4.2% right now? And that is historically, quite low, right? We've got stocks near all-time highs. They're having kind of a rough week right now, but we're still not that far off from all-time highs. Home prices, on average, are still at all-time highs, pretty much. And like you said, normally the Fed is cutting when the economy is in trouble. We have what we had. I think Q2 GDP was revised up to 3% from 2.8%. And I haven't looked at GDP now recently. Maybe we can pull it up here while we're talking. But last time I saw it, it was 2.5%. So, from the headline numbers, things look okay. And of course, this is what Jerome Powell says every time he comes out in the podium and saying, hey, certain things are normalizing, like the jobs market, but this is all good. We got everything under control. Soft landing, no landing. That's the whole narrative here. It does beggar the question that you've asked, which is, well, then why is the Fed cutting here? These are not conditions under when it normally cuts. Now, the Fed is saying, well, we don't want inflation to get too low, right? It's got disinflation has some momentum. We don't want to get too far below 2%. Honestly, I don't know anybody that would worry all that much if we had a little bit under 2% for a little while, especially after the injuries we've taken on the inflation side. So, what do you think the odds are that this belies not confidence on the Fed's part, but worry? And presumably the market must think the same thing. I mean, the only reason the Fed would be cutting 200 basis points in the next year, the only reason it would cut that aggressively would kind of be if it's really trying to get ahead of something bad, correct?
Yeah, Adam, I think there's a good chance of that. But honestly, Mike and I and our team here sometimes scratch our head because some of the things that come out of the Fed, and I'm not just talking about recently, but over the last decade plus, so much of it is grounded in academic dogma that it seems to be completely out of touch with the realities of people and Main Street. Think about the policies of the last 15 years, or certainly not the last few years, but the hallmark policies coming out of the great financial crisis. What did they do? They printed money out of thin air with the stated purpose of A, elevating asset prices in a distorted way, and B, making it so painful to hold cash that people would run into risk assets. Essentially a massive psychological torture experiment to hopefully create this wealth effect that gets people spending. The problem is that it totally ignored the complexion of our society. So many folks don't have significant assets. So many folks need the savings that normal interest rates would have provided. So it was a really massive experiment that had far-reaching implications that we think will play out for years to come. And here we are, and I'm not going to kind of take sides in a political debate, and I know we'll talk about this later, but now the solution is to tax unrealized capital gains when much of those capital gains were fueled by interest rate policies that were very intended to distort asset prices, inflate asset prices with a trickle-down hope of benefit to the common man and woman. It just seems, so sometimes the Fed, it just seems they're mirrored in just an echo chamber of academia, I saw a headline, we talk about antitrust actions in corporate America, or when there's too much of a monopolistic acting in corporate America. Well, someone raised, I think, the rightful question: is there a monopolistic dogma of thought in our policymakers? Everybody's Keynesian economics. Virtually the whole Federal Reserve Board is trained in a certain kind of academic style of monetary theory, and begs the question: is the dogma even at all applicable to what we have in front of us in terms of real society? So I don't mean to kind of get too philosophical there, but sometimes the actions aren't necessarily grounded in nuts and bolts solutions, but more dogmatic knee-jerk reactions.
Okay, so your point basically being we have a Fed that may be using ivory tower logic that might not really apply to the reality on the ground here. And look, I'm digging into this because this is one of a couple shoes that I want to talk to you guys about that could be dropping here, that could maybe trigger a downward repricing in the markets. And John, you mentioned how generally overvalued, or at least richly valued, the markets are right now. So this could certainly be one if the market sort of wakes up and just says, hey, you know what? Employment's a lot weaker than we were pricing in. Now we got to start discounting prices because of that. All right, Mike, I want to invite you to add into this in any way that you like. I know that you have been, pretty consistent about saying, you think that there is going to be some sort of reckoning here with stock market valuations. Is this visibly worsening jobs data? Do you think that that could be the pin, or are you worried about other things?
I have no idea what the pin is going to be, Adam, to tell you the truth. People ask us that all the time. What's the catalyst going to be? And I'll be the first to admit that this game has gone on a lot longer than I thought possible. You and John just talked about the Fed cutting interest rates a quarter point or a half a point. Who really cares which it is? Maybe day traders or swing traders that trade week by week care. But, the point is that rates are being cut for the first time in a long time, and on the Fed funds to target rate, and it's happening at all-time high valuations. I will share up a chart that our good friend John Hussman came out with just a couple days ago. It's a chart that we all know and love. This chart here is John Hussman's favorite metric of market valuation. It happens to be non-financial market capitalization divided by non-financial corporate gross value added. It's a small twist, very similar to market cap divided by GDP. But John has found that this has higher correlation to subsequent returns.
Okay, so sorry to interrupt, but this is Hussman's version of the Buffett indicator, right?
Absolutely. Yeah, the Buffett indicator is market cap divided by GDP. And I would think that even Warren Buffett has been surprised by how long this market has maintained lofty valuations to seemingly no consequence. But, John Hussman's been out there with his version, and it's very similar to Buffett's indicator. And as you can see here, this is just a week or so ago, we're at all-time highs. We're higher than the 2000 peak. We're higher than the 1929 peak. I haven't found anyone else out there putting together a model or data. We haven't seen anything else that goes back this far. Now, the problem with all of this is that it's been overvalued for most of the last 25 years. And that's probably what critics would say of a valuation-based metric or a valuation system. It doesn't matter anymore, right? The only thing that matters is the Fed. So, each time we've had a pullback, we have seen bigger and larger interventions with monetary policy. But that's not to say it doesn't matter. That's the whole thing. It's a faith-based situation we're in. An investor has to decide what to put their faith in, either central banking or math, basically. We believe in math, but John and I will admit that it's painful to just believe in math and think that it's going to matter, because sometimes it doesn't matter for a long time. John Hussman has done some really good work, albeit it hasn't mattered for 15 plus years. I'll be the first to admit that. So valuations are obscene, and there's other charts that John Hussman puts out. Why don't you take my word for it that the dot plot that we've seen in previous videos that we've often shared before shows about a -6% annualized return on the S&P over the next 12 years. It hasn't mattered for so long, but it will matter. Take a look at the next chart in Hussman's piece here. This chart basically shows the deepest actual loss in the S&P over the subsequent 10-year period. And the blue line is the estimated S&P loss to reach a valuation norm associated with an actual 10% average annual nominal returns. Basically, what it's showing is when you have hyper overvalued situations, because this blue line says, what does the S&P have to lose to give 10% returns? That number happens to be around 1,800 on the S&P, a number that you probably heard us say before, but look, it hasn't mattered. It hasn't mattered since 2010. That's almost 15 years ago, right? So you could almost lose your mind waiting for that, but it doesn't mean it's not going to happen. I think that we're living in a very climactic time. This certainly is the fourth turning that we're in. So you'd expect that all stops would be pulled. So we should have a 70% decline if we ever get back to valuation norms. And so that's the whole ball of wax here. Do you have faith that that's going to happen? And yes, like you said, what's the catalyst? I don't know. But it's likely that we're going to, see this red deepest loss come down to this level at some point. Some point here in the next few years, we're going to have a 2/3 loss in the market, or we should, if math ever matters again. So that's the point. So why are they cutting? Why are they cutting? With valuations here, we're cutting rates into the pinnacle of the largest bubble we've ever seen in our lives. And what are the effects of all of this? Well, the effects, I think, as John had just mentioned, is this a psychological torture? The wealth effect has been unfair, and now there's political pressure to do different things, particularly tax unrealized gains. We're running out of runway. Bottom line, we're running out of runway. So why is the Fed going to cut? I guess because they have to. Ultimately, they have to because of the mountain of debt. And so that's probably what we're going to see. And who knows what the short term brings? It might very well be a further vertical move, blow off top, or it could be a sell the news reaction to the Fed cuts. Who knows? The bottom line is we're in dangerous territory. So be careful. And we're happy to help if anyone wants to talk.
Okay. So dangerous territory, no one knows for sure, what the trigger may be if we do indeed have a big downward repricing. Maybe it could be this. We don't know for sure. But what you're saying, Mike, is, hey, what does look as certain as anything is in this world is that interest rates are going to be coming down in the near future. So I've showed this chart before, but let me just show it again. Here's a chart of the federal funds rate. And it's mapped over the past recessions that we've had since the 50s. And you can see here in almost every case, a recession is preceded by a Fed hiking regime. The Fed hangs out there, the rate plateaus for a bit. And then there's sort of a fast and furious effort on behalf of the Fed to cut rates. And that's usually because the economy is entering recession, which are the graded sections here on this chart. And the Fed has realized, oh gosh, we brought rates too high. We held them there for too long. We got to get things down here again. So, one of the questions you have to ask yourself is, well, what's different about this time? Why should we expect a soft or no landing when we're following the exact same pattern of the past? And here we are. We've hiked rates really aggressively. We have hung out here, plateaued with higher for longer. And then now the Fed has told us they're going to start cutting rates. So I think a natural question here is, well, okay, well, if history is any guide here, should we then expect the economy to start entering recession and the Fed to be scrambling to cut rates? And I do wonder if that chart you showed, John, that table that suggests that even though the Fed right now is being more cautious about how many interest rates to expect, the market is certainly expecting a fair amount, 200 basis points worth in just the next year. Right. So I'm wondering if the market is beginning to say, you know what, the Fed's going to have to start scrambling here because it's going to realize that it held interest rates too high for too long. I don't know. We'll see. Now, as somebody who has been beating the drum about the lag effect for a long time, I wouldn't be surprised if that's exactly what we see, because I think the signs we're seeing right now in the employment market are signs of the lag effect finally beginning to express itself in the real economy. I think a little bit too early to claim victory on that, but certainly the trajectory of the momentum is in that direction. We'll see. But here we're coming to the second big topic I wanted to talk with you guys about, which is, okay, so you guys have confidence that rates are coming down. The market has confidence that rates are coming down. That's what the Fed is telling us to expect. So if indeed that's the case, John, you were saying one of the kind of travesties of the past, let's say 20 years, was that because the Fed had pushed rates so low, investors were forced out onto the yield curve to be able to get return, right? You couldn't really exist on a fixed income like many seniors had expected to, because your fixed income instruments were yielding you near zero in a ZIRP world, right? So people have been forced out into riskier assets they had no business being in. Well, the past year and a half, 2 years have actually given people a bit of a lifeboat, right? You've been able to move into T-bills and money market funds, the whole T-bill and chill trade, right? And for the past 2 years, you've been able to get a nice return in safety and a real return on an inflation-adjusted basis. So a lot of people have taken advantage of it. There's been trillions that have flowed into that trade. I know you guys have been in it. I've been in it. If that trade is now going away because we have a lot of confidence that interest rates are going down, what do you do as an investor? And what will investors do, right? As that capital starts to move into other instruments, what impact is that going to have on the financial markets, right? So I know we touched on this a little bit the last time that you guys were on, but I think it's worth really digging into, because I think investors are this is really just beginning to dawn on them. Like, oh, I've kind of been able to get nice and comfortable here in my T-bill positions, but now I'm looking forward and I'm seeing, wait, in a couple of quarters, when my T-bills roll over, I may only be getting 3% or something in the twos. And is that worth it to me, or do I need to start either chasing yield or looking for some other safe instrument, but one that gives me a better return? I'm sure that some of your clients are asking you guys the same question. I'm seeing it a ton in my social media. So maybe, John, let me hand the baton back to you. For investors that are really wrestling with that, how would you encourage them to think through this process?
Yeah, great. Well, the first thing I would tell folks is to not panic in the sense of, look, T-bills are still a very compelling rate. You can still get short-term T-bills 4 months out over 5%, right? It's not going away overnight. There's a degree of relative attractiveness of moving things out on the yield curve. Just to give you, for example, we have T-bills that are maturing 3 months out, 6 months out, 12 months out, and 18 months out right now in our portfolio. We also have about a 10% allocation to longer term bonds, treasury bonds. So we think starting to stagger out in longer maturities makes sense, but by no means do we think, tomorrow or on September 18th, if the Fed drops 25 basis points or 50 basis points, you should take all your short-term T-bills and suddenly roll out to 10-year bonds or things like that, because there's still a lot of dynamics here that can play out, including, to my point earlier, I think the market has maybe gotten ahead of itself in terms of the pace and depth of which the Fed will drop rates. So I think, putting it in a nutshell, I think there's probably better time, for example, to be buying 2-year treasury notes than right now. I do think there's some likelihood of a backup in yields on those. We did buy a piece several months ago at 5%. We probably won't get back to 5%, but we're at like 3.6, 3.7, I think, right now on the 2-year note. Would not be surprised to see that get back closer to 4. Okay, but a selective starting to stagger out in the longer term. But understand what we're also saying here. We think if the Fed is going to cut at the pace that the market expects, what you're also likely to see is stocks start to sell off pretty dramatically. And that very well may be the right place to find the place to chill, because valuations, if they come back significantly enough, will be very compelling for certain sectors, certain geographies. And there are times to take risks in the market, and there are times not. And when it's time to take risks is when markets have repriced the forward returns, and that's inarguably when markets pull back in price. So we do think it's going to be a multi-pronged thing, very tactical. I think this begs the question of people have been simplistically ingrained to think about what lower T-bill, what lower federal fund rates mean. And John Hussman, to give him some additional credit to the work that Mike just pointed to, he has gone through and looked at. So, for example, one common misconception is that, oh, if short-term rates drop, so too will long-term bond rates, 10-year yields. When in fact, and I might as well share a chart here just to kind of put it in color for folks. This is a chart that goes back. He looks at every basically prior cut, and it shows on average that the average and median that the yield on 10-year bonds barely drops when the Fed starts to cut. And in fact, in a number of scenarios, the yield actually rises. The only time that the yield has dramatically dropped are some outliers when the starting yield on the 10-year was about 12%, far cry from where we are right now. Think of the early 80s, for example, 81, 84. That's what these are. So the idea that long-term bonds are going to drop and therefore be a no-brainer trade is not quite that simple, especially.
Okay. And sorry, you meant yields on long-term bonds will drop.
Well, it's not quite that simple. They very well may not drop at all, and they could rise. Just to juxtapose this, for example, Goldman Sachs came out and basically made a buy recommendation on gold. Joining Bank of America, for example. One of the reasons that Goldman Sachs highlighted this is they noted the profound change in the posture of central banks in the world to steer towards gold. It's certainly been the trend over the last year or so, and they think it's going to continue for a number of reasons. One is the understandable fear by foreign central banks that the U.S. government will use its reserve currency as a sanctioning tool. We've seen it play out with Russia and other sword rattling with China and things like that. But also the concerns about the burgeoning budget deficit at the U.S. level. I mean, these are all things that are somewhat game changers in terms of the traditional dynamics of long-term yields. The other kind of, might as well finish this thread. John Hussman, for example, also looks at the effect of short-term rates on market valuations. Again, to the point that many people have been trained to think if the Fed starts cutting, well, great, the stock market's going to take off. More heroin for the stock market. Well, that's not actually the case. On average, in the median, valuations actually decline, and this is going out months from the initial rate cut. And the only time where the valuations have actually increased is when market valuations are at fractions of where they are today. When market valuations are rich like they are today, invariably the valuations drop in response to the Fed cutting. Why is that? We already talked about it, because they're dropping not out of a point of health, but a point of unhealthy economy, unhealthy markets that have gotten way ahead of themselves. And then I might as well finish the thought here. Here's with the unemployment rate. Fed starts cutting, and actually, on average, the unemployment rate continues to rise. So this idea that the Fed all they have to do is cut rates, and this concern about weakening job markets is suddenly solved, history bears that out as not being something.
Yeah, I think there's almost zero data to support that one. Yeah.
Yeah. So, point being, yeah, there is a case to be made to start to inch out some duration on your fixed income piece, but there's a very good case to be made to keep staying short, because that represents a form of dry powder that's not affected by interest rate moves in any big way, that can be deployed in things like stocks that have sold off in line with what we expect to be ultimately a pretty large sell-off in the face of weakening economics, you name it, whatever the case might be.
All right. So just to summarize what I think you just said there, John, was, yeah, maybe you could consider, if you're in the T-bill and chill trade, you're looking at the potential for lower interest rates. Yeah, you can maybe take some of that and move a little bit out the duration curve, but do that more to try to lock in a good rate, and maybe wait to see if yields creep back up again and take advantage of them then. But consider any sort of appreciation in price of the underlying bond as like an option value. Like don't do the trade for that reason, but if that happens, great, that's an additional benefit for you. But you won't be disappointed if long yields actually don't move very much when the Fed starts cutting rates. I did hearing from you, hey, be real wary about moving that money into equities at this point in time because they're so overvalued. And therefore, yeah, maybe you're going to stay in T-bill and chill with a good chunk of your existing capital, and it's going to yield less, but it's still going to be giving you a positive yield. But more importantly, you're going to have the liquidity to be able to move that capital into stocks and other assets at better valuations, if indeed we get this market repricing that you guys think is more likely than not to happen at some point in the coming future here. And also, I heard you say, hey, gold might not be so bad to put some of that money into too, because more and more the world is falling into favor with it. Did I capture that correctly?
Yeah, I think you encapsulated that nicely.
Okay. So, all right. Well, look, that's item number 2. Item number 3, which kind of goes back to, hey, what's another shoe that could drop? So we talked about a couple of shoes here. Unemployment looks like it's continuing to weaken. Interest rates, we've got greater confidence that they're going to be coming down in the future. Number 3 here, and I'll come to you with this, Mike, is AI. So, we've been talking a lot about how the narrative, the mania, many would say, around AI has driven a lot of the increase in market value over the past 2 years. It's definitely what sort of lit a fire under the markets coming into 2023, where people initially had a pretty negative view on the year, and then the markets just totally fell in love with the AI story. We've seen some massive high flyers in that space, NVIDIA, being the poster child for it, but just gargantuan amount, trillions in market cap, generated by even just a few stocks in the Magnificent Seven around this over the past 2 years. And we've talked about how this looks a lot like a price asset bubble. We've seen this several times, a number of times in living memory, where investors' exuberance around the riches that could be made in a new trend drive stocks to valuations that really need almost like nirvana times perfection to happen to be able to justify the current asset prices. And I've increasingly been echoing Fred Hickey's warnings from when he came on this channel last, where he said, hey, look, there's been so much spending going on in this space, and we haven't really seen enough demonstrable either increase in revenue as a direct result of implementing AI spend, or enough cost savings to justify the almost $1 trillion in spending that's gone on in this space. And that it's highly likely that a lot of the spenders are going to say, hey, you know what, maybe we got a little too aggressive here. Let's start cutting down our spending until we can really justify the ROI. And increasingly, I think we've seen people at the fringes start to raise that concern. It's now beginning to enter the mainstream, and right at the time where NVIDIA, they just released their latest earnings, still had blockbuster earnings, but for a stock that's priced to perfection times nirvana, there were a few things that worried people there, like the profit margins. For the first time since the AI craze started 2 years ago, their profit margins shrunk, right? And the stock has been taking a beating. It just was announced that the government's looking into some antitrust action against them, and so more and more people are now starting to say, "Hey, wait a minute, maybe these valuations are unrealistic, given what we're increasingly seeing as more time goes on, and some of the challenges that some of these perfect companies are now facing." So NVIDIA, I just mentioned a few issues, but another one is just competition. The sector's been seeing what an amazing feast NVIDIA has been enjoying, and are saying, hey, we want in on that, right? So anyways, Mike, if I'd like to get your thoughts on the AI trade, but specifically, if indeed the bloom starts coming off this rose, how material is that going to be to the markets? Because again, as I said, the amount of market value that's been generated on the hopes of the AI space recently has been just gargantuan.
Well, AI is pretty cool. I'll be the first to admit it. And I don't know about you, but perhaps a lot of your viewers will, have experience now being in Zoom meetings or Microsoft Teams meeting, and you see that there's another participant in the meeting, and it's the AI note taker. That in itself is pretty cool, and you can actually have an AI bot take notes on your meetings or transcribe your videos, for instance, and all kinds of things like that. You can even have AI do clerical things. There's the argument that you can cut the workforce, like legal firms, for instance, or accounting firms can cut a lot of the clerical functions and therefore save labor costs. All of that's probably true, but like usual, I think that probably it's very difficult today to quantify exactly what those savings are going to be. And we've seen a lot of these names go completely probably ahead of their realistic valuations. But you have to remember that we're in a bubble, probably the biggest bubble any of us will ever see. So it's not surprising that everything kind of gets overdone to the upside. And there's no telling just how far that can be. I started in this business in 1999. It was interesting to see the tech bubble back then. And what we're living through now is many, many multiples larger than that. This is the bubble that just moves from one space to the next, and it never really ends. But AI has been the big leader, you're right, for the last couple of years. And we're starting to see NVIDIA. Let me just kind of pop up the chart of NVIDIA, and we'll take a quick look at it.
Right. And as you pull it
So,
up, let me just note that NVIDIA is currently priced at 30 times price to sales.
yeah, and
Right.
I remember doing a video here with you, Adam, and it was one of these earnings. Down here is the earnings reports, and I can't remember which it was. It might have been this one. And I remember us saying here, well, look, it's NVIDIA is 80 times sales. What we didn't see, what we couldn't have foreseen during that time is that sales would have grown so rapidly that it's only 30 times sales. Now, I say only kind of tongue in the cheek, but 30 times sales is a lot. So here's what NVIDIA did. It went to a high of 1400, I think it was. Had a 10, I believe it was a 10 for one split. It might have been an 8 for one split. But anyway, it was way up here. This is all post split now. And, we have fallen here the last couple days. And here's the earnings report last week. You're right. The margins were a little softer than expected. And we came down to here. But let's back out. And this is a theme that I kind of want to mention here is that traders and investors should really broaden their time frame and slow down because the number one problem for most people is emotion if you're trading short term. But that is not to say that you should just be 100% invested and leave it there forever. But I would say that if your position size is right, don't get too worried by the short-term gyrations. But here's NVIDIA. Let me go back to a monthly chart. The monthly chart is what a lot of people should be using if they're intermediate to long-term investor. The problem is with things like NVIDIA, you're like, well, how do I jump out of this thing? Selling is very difficult. The best you can do is sell on the way up, and you're going to feel stupid because it's going to keep going. But you really should just set some kind of percentage target to your allocation and then keep selling on the way up. So here, taking a look at the monthly chart of NVIDIA, let me zoom in a little bit. It really hasn't given us any real reason to think that it's done, other than the price to sales is still ridiculously high at 30, and even the PE is ridiculously high, but we don't know just how far AI will push things. I will say that we're starting to see the NASDAQ be weaker and the AI names be weaker, and that we're starting to see a broadening in the market, a shift out to more value names, industrials, et cetera. But if I had to guess what's going to happen here in the next few months, I'd guess that NVIDIA makes a new high because I don't think the S&P is quite done yet either. And that doesn't mean that I don't think the S&P is hideously overvalued. Let me go to the S&P here just for a quick second on the monthly. It just hasn't, I don't think, shown much of a vertical blow-off move yet. Take a look at what we've seen in the last month in August on the monthly bar. I'll zoom in a little bit here. We closed right at the top. And you say the market's having a rough week, but it's hardly down. I would kind of expect a big bar up here, an all-in moment, potentially a push above 6,000, before I'd start to think that maybe finally this long bull market is over. That's not to say that we're trading that way or we're taking a lot of risk. We're only 40% stocks. So you got to pick your allocation. You're going to want to slow down things, go out to the monthly or the weekly or monthly chart. There's one more thing I'd say, just to make sure I get a chance to put it out there. Taking a look at gold and silver. Take a look at the monthly chart of silver. How many years it went through this consolidation in this triangle. And then boom, it broke out big time 6 months ago. And it topped in May. But look at how frustrating these last 4 months have been. I've looked at things on the internet, YouTube, etc. People are feeling frustrated with silver in particular because it's underperforming gold. I'm feeling it. Heck, I'm human too. But if you really sit back and look at this, silver can make big, powerful moves out of consolidations. And silver hasn't done anything wrong, and nor has gold. I actually expect silver to break out here into the 30s. This is actually SLV, not spot silver. The reason is I don't have futures quotes here, but silver looks great. Gold looks great, looks even better. All of that is to say, slow down, take the look at the big picture. Don't put 100% of your money in silver and say, hey, Mike said it's going higher. But if you've got 5% or 10% in it, don't worry about it. Slow down. Look at the big picture. I think silver and gold are going higher. Ironically, I think that stocks might short term in the next few months go higher too, but I'm not willing to bet on it. And the T-bill and chill trade still for a good portion of your cash is exactly what you should be doing.
Okay. Let me just put a bow on the AI trade, and I hear you, Mike, which is, you if you had to guess, you would expect to see some sort of real blow off upside move in the AI stocks, which would also do the same thing for the S&P and the NASDAQ, given how much of a percentage they make up of those indices. You would expect to see that sort of last gasp before this thing rolled over. To my question, and then that could totally happen, right? To my key question is just, so if indeed the bloom does come off the AI rose, that those companies that are making the big CapEx investments right now say, you know what, I actually am going to throttle back my spending, right? And that does start to materially pull the market value of those key high flyers down. How big of an impact would that have on the markets? How big of a risk factor is that to today's markets?
Well, that could take the whole thing down. Let's not forget, from these valuations, we're talking about end game stuff. The only question is, does it happen from a higher level or right from here? I fully admit that we could crash right from here, and we're prepared for that. That's why we have 40% roughly stock allocation with a 15% S&P put that's slightly out of the money. That would take us to 25% very quickly on a drop, and then we would take stops from there. Nobody knows the future for sure. We don't either. Some of what I say is based on guesses, experience, based on chart patterns, that kind of thing. That's why we're 40% in, hoping to squeeze a little bit more out on the way up and not really give back much on the way down. But yeah, if AI, if the whole thing became clear with the data that it was hyped, if earnings start to fall consistently over the next quarter or two, yeah, the top may be in. The top may be in. I'm just guessing that it probably isn't. But this is what's so hard for the individual investor. How is the individual investor supposed to navigate this? The people that are in T-bill and chill, if they see a drop to 4,800 on the S&P, which is like 15%, are they going to sell their T-bills and go into the market because we've seen the first big pullback? 4,800 on the S&P is nothing. We probably would layer in a tiny bit there with hedges, but we just said early in the conversation, we think the market should go to 1,800. To have 10% returns. So how do you get down there without major damage? I think a big risk for people that are doing T-bill and chill is that they'll come out of T-bills too fast and they'll start layering into the market too fast. And how do you differentiate noise from a real signal? That's hard too. You almost really have to, like I said before, pick an allocation, stick to it, have some conviction, yet be flexible all at the same time, and realize that everyone has biases. Even we have biases, which is why we have an investment committee with votes and debates and that kind of thing. So yeah, AI, if that bubble bursts, I think it's going to be hard for the market to go much higher, and that could probably stick a fork in it and it'd be done. But my guess is it's got another leg higher first.
Okay. I appreciate how you sort of describe the dilemma that's facing investors, particularly regular investors, of like, oh my gosh, like how do I navigate what's coming here? Because even if some of these things we're talking about do come to pass, then you have the question of, all right, well, when do I take action on that, right? And I know a big worry you've mentioned in the past, but you just reiterated it here is, hey, you might misinterpret the signs and see, and give yourself the all clear too early, and you jump in, and it turns out you're catching a falling knife, right? So you did everything right by staying in dry powder, but then you deployed your dry powder too soon, right? So that's the whole theme of this video here, which is, what we think are some of the more likely shoes to drop, and then, how to try to help people come up with a strategy. Or, I think to what you guys do is say, hey, look, admit to themselves, look, I don't have the time, expertise, iron stomach, whatever for this. And rather than trying to surf it myself, I need to try to find a good professional who is a good match for, my outlook on the economy and the markets and my risk tolerance and all that stuff, who can do this for me and be my financial quarterback. Okay, so we've talked about the weakening jobs market shoe. We've talked about the high likelihood of a drop in interest rate shoe. We've talked about the potential AI shoe to drop. Now I want to get to one that I'm hearing a lot of people reach out to me about, which is, hey, I'm beginning to get really concerned that the increase in the cost of living is going to continue to be a lot higher than just the reported inflation rate, right? We keep hearing the Fed saying, hey, inflation's now got a two handle, right? It's 2.9%. But then we read stories like, I live out here in California. Allstate is going to increase property insurance on average in the state by 30-something% next year. I think it's 34%, right? So a very high double-digit increase in kind of an essential, right? You don't want to go naked on a big asset like a house in terms of not having insurance on it. And I know everybody watching has their own version of that story and something that happened to them recently. Oh, my auto insurance just went up by double digits. My healthcare premiums just went up by double digits. I went to the store and this essential I always buy for my family, oh my gosh, it's 12% more than it was last year, right? So we're continuing to see these increases in essentials for living that far outstrip the stated CPI. And so understandably, people are beginning to say, I'm afraid that this is becoming a secular thing going forward, meaning that it's not just a blip of a year or two. I'm worried that no matter what I do in terms of working and saving really hard and putting my money to work in the markets, that whatever return I get from there is not going to be as great as my true annual realized rise in my cost of living. So that as time goes on, despite running faster and faster and doing the right things, my wealth is going to be getting less and less in terms of real purchasing terms. And I totally understand this worry. So, John, let me hand the football to you. How do you help people cope and address and come up with a strategy around this?
Yeah, well, you hit the nail on the head, Adam. This is ultimately is about clients and their money and their ability to live comfortably and hopefully stress-free, right? It's not about beating the market. It's not about being in all the hot stocks. It's about, for our clients anyways, it's their hard-earned savings, their sacrifice, so that they can enjoy the fruits of their labor. And nowhere is it more apparent than in being able to cover, hopefully, their cost of living and increases to that. Unfortunately, we don't have any quick, easy answers there, and some of it is a function of what's baked in the cake. So, for example, the traditional thinking or logic is, well, I can't hold cash because it's going to lose every day to inflation. And there's a certain truth to that in a long-term sense. If you look at the returns of stocks and bonds and cash over the last 100 years, there's no doubt, hands down, stocks have been the inflation-adjusted best place to be if you were simply holding for 100 years. But in the shorter term, that logic can completely get lopsided and turned upside down and prompt folks to do the wrong thing. So, for example, in the 70s, when inflation was last, the major thing on people's minds in any big way, stocks and bonds both lost money on an inflation-adjusted basis. through the decade of the 70s. Cash actually did better, right? Now, that's not to say you should have been passively in cash for the 70s, because in fact, the 70s had 2 or 3 very sizable stock market pullbacks that could have been taken advantage of in the short term to create returns in a tactical way that could soundly outpace the rate of inflation. So sometimes the easy answer is not there, and it takes a bit more skill and hard work and tactical differentiation of where to put your money. And sometimes just being safe is the right thing to win the battle. You may lose in your mind this month's war against inflation, but you'll be better able to handle a decade's worth of inflation by being more tactical and smart with how you position your assets. That is one of the key factors here, I think, in this whole debate about interest rate policy, because we can talk analogs all day long, but the 70s is an analog of 3 separate bouts with inflation, largely caused by policy error. And you might say that, I'm not going to predict this, but it's certainly a plausible scenario where if the Fed does come off too aggressively on rates, they're going to just bring that boogeyman inflation right back onto center stage and create a even more distasteful situation for the common man and woman. And at the end of the day, whether we're talking about politicians or hubris-laden Federal Reserve governors or academics, it's all about politics, basically, and it's all about popular opinion. And if the choice is to let the stock market fall or have riots in the street because people can't afford food and shelter, you betcha at the end of the day that the riots in the streets are going to try to be avoided if even they can be. But it is a tricky time. The first thing is to acknowledge that, to not try to solve a problem by pursuing something that on the surface seems like the right answer, when in fact it might be the very wrong answer. And we work with our clients very closely to talk about these things, bring it back to what is their needs, what are their needs, how are their resources positioned. Oftentimes clients think they are much more resource constrained with their financial assets than they really are. We can help them walk through scenarios and say, you know what, I'm a lot more well off than I thought I was. I can relax. I can live my life. I don't have to be sleepless at night every day because I'm worried about running out of money. I've got, on a range of plausible scenarios, I've got more than enough. And yeah, it's not to mean you can be careless and spendthrift, but breathe and live a little. If there's one metric of our job, it's how well our clients can rest easy in their lives and trusting that they're going to be okay.
John, can I make one point on that, which is, because I think it's really important, is the value of going through that exercise that you just mentioned there is really high, because people in general, we're relative animals. We measure ourselves relatively, and they just feel like, well, I got to try to beat the S&P every year. That's got to be my objective with my investments, right? And no, what you really want to do is you want to determine what your life goals are and how much money you need to have by when to meet them. And you may be able to find out that, hey, to get there, you might be in better shape than you realize, and therefore you can get there with less risk than trying to beat the S&P, because investing is about risk and reward. And yes, there are things like the stock market that delivers an average return over time, but it's an average return, right? It has good years and it has bad years, and a bad year can set you back sometimes years or decades, in your progress. And so if you turn out that you only need a 4% return annually to hit your goals by the time you want to hit them, wow, that gives you a much better option set to be able to really sleep at night and have a lot more confidence you're going to hit your goals, than continually getting up the plate and maybe swinging for a home run every time, and nobody hits a home run every time, right? And you might actually have some pretty bad strikeouts. So you're nodding as I'm saying all this, John.
Yeah. The one other thing I'll point out, and there is this, I think it's right in front of our faces, this kind of contradiction or maybe puzzling departure from the inflation statistics that the policymakers talk about, the personal consumption expenditures, the CPI, and what people really feel like is their cost of living. And there rightfully is in people's minds anyways, and probably in very real reality, a inconsistency in those measures. People feel like, hey, things feel a lot more expensive, while the politicians and policymakers, cheerlead that inflation has dropped from 9% annual rate to 3%. I still feel like I'm paying more, which in fact you are. You're paying more, but just increasing at a slower rate. But even the measures that are used with the hedonic adjustments that the economists put in there, hey, your car may cost more, but there's so many more bells and whistles that it's actually cheaper than it was 5 years ago, even if those bells and whistles mean nothing to you in your quality of
Right.
life, right? So there's all kinds of data gimmicks. But we can look at like forward break-even yields on inflation-protected bonds and nominal bonds, and at least get the market's expectation about what inflation is. So I think, for example, the 5-year forward break-even yields project or estimate that the inflation will run about, I think, about 1.9% right now. It's sub 2%, I think, on the 5-year break-even. Whether it's right or not, who knows? But that's what the market is pricing in. So they're pricing in a decline in future inflation over the 5-year horizon below 2%. Again, that doesn't speak to the data inconsistencies between what people's real cost of living is and what the data books show, but I just want to point that out.
Right. And also too, just to make it really real, we could potentially get a period of deflation, which could bring prices down on average, at least in certain parts of the economy, which you could say, okay, well, that's good, I guess, because it provides relief on the rise in cost of living. But oftentimes when that happens, that's commensurate with a lot of job losses. And deflation doesn't do you any good if you have no income, right? So, there are all these issues to think through. And I think kind of the key takeaway from this is look, there are strategies that can be applied and customized to the individual. And if you're somebody with a lot of these questions about, hey, if I'm worried about this, how can I make sure I don't get eaten alive by inflation and cost of living as time goes on? Find yourself a good professional advisor to create one of these, do a whole review with you and hopefully create a customized plan that gives you more comfort to use going forward. All right, guys, we're hitting the hour here, so I got to get in the lightning round. I'm going to end with you, Mike. So one last question for you, John, and I hate to ask you to just give a 60-second response to something this emotionally charged. We can dig into it more deeply, perhaps, in a future video. But we're in the presidential election cycle. There are all of a sudden new policies getting floated right and left. We're now seeing some policies that say that, hey, the capital gains rate could pretty much double from here. And then for certain types of people on the wealthier end of the spectrum, you might start seeing taxes on unrealized gains. If indeed those were to look, I just think any rational person can hear things like that and say, oh my God, if that happens, then investing is going to get an awful lot harder because I'm going to get a lot less yield for my efforts, right? The government's going to be taking a bigger share of my efforts. And of course, taxing unrealized gains just opens a whole hairball of like, well, what does that really mean? And what happens if you have unrealized losses? I mean, there's just a whole big potential real mess coming out of that thing. But what are your general thoughts? Is it, hey, just don't even worry about it until we see what happens after the election and how much of this is just campaign chest beating? Or are this really something to start having some concerns that might require some planning on the behalf of individual investors?
Yeah, it's a good question. There certainly are dramatic proposals like the proposal to possibly tax unrealized gains. Look, it is political theater, I truly believe. And let's not forget that these kinds of things need to make their way through Congress. A president just can't, by decree say, hey, the capital gains rate is now this, or we're going to tax unrealized gains. I think it's going to be a long, and if that even gets into real time active debate, I think it's going to be a long slugged out thing. It kind of repels the mind a bit. On the surface, it sounds great. Let's get some windfall tax revenues, especially for those part of our society that feel disenfranchised, that don't own a lot of assets and feel like they've been looked over while the deep-pocketed Wall Street. So I get it. There's a certain political appeal to that and yearning for the populace to feel like they're getting their fair share. I don't think that is very likely at all to pass, and I don't think it's going to get much further than. That's not to say there are planning considerations, like, for example, this the idea that we automatically get a step up in basis of unrealized capital gains at death. Absolutely, I think that could get tinkered with, taken away for certain threshold amounts above a certain level. So there will be changes, no doubt, I believe, because we have a massive budget deficit. But I think the truly bombastic idea of, hey, we're going to tax unrealized gains, I think that's going to have a really hard road to hoe. And we don't have too many $100 million clients anyway, so I think the proposal is for that to affect only people above 100 million in net worth. But
that one, although of course everybody has the camel's nose under the tent fear, which is once they do it at the top
Yeah.
level, it'll make its way on down. But just to the potential increase in just the capital gains rate itself, a question that I think a lot of individual investors are asking themselves is, hey, so if I've got a position that's done really well and I'm sitting on some big capital gains, should I take them this year because the capital gains rate could go up dramatically next year?
Yeah.
So do you have any thought? I mean, what I'm taking from you is like, probably don't make a big decision like that based on that fear, because it's probably more political theater than anything else. But
yeah, I think the threshold question should be, how big is that position, irrespective of whether gains rates stay the same or they double or whatever. We always say tax planning and tax investment considerations are very, very important. We're not going to downplay, but they shouldn't be the most important. If you have 80% of your money in a single stock and you have huge gains, unless you're months away from possible death and a step up in that basis, it absolutely makes no sense to have that much concentration in a single stock. Yeah, we can put hedging tools around it, but the best way to hedge and the cheapest way to hedge is to just simply sell down an overweighted position. So absolutely, I'll say emphatically, if you have a dramatically oversized position, don't even worry about whether gain rates are going up or staying the same. Think about the investment merits or lack thereof of having such a concentrated position. And guess what? Paying capital gains is a darn good thing because you have gains to pay them on. The worst situation is to have those gains evaporate. And yeah, you don't owe taxes, but I can guarantee you mathematically you're worse off. Pay those taxes if you have gains. Enjoy them. That's what you're supposed to do with those gains.
All right, got it. Okay, Mike, coming to you to bat cleanup here. Last question is, I've also been hearing a lot from viewers of these videos that, most people who come to watch these videos are doing it to self-educate, to make themselves better investors, to help them make more informed investment decisions. And just as the dynamics play in a family, and particularly in a couple that's running a family, one person tends to specialize, in certain things, and this spouse or partner specializes in other things, right? It's a complementary relationship. And the person who is kind of in charge of the family finances, particularly the family's investing, they, will have generally what tends to happen is somebody has a wake-up moment. They get a bad, scary health diagnosis, or they have a death in the family or whatever, and it kind of reminds them of their mortality, and they realize, hey, I'm the financial quarterback for my family. And I kind of have all the institutionalized knowledge about, not only where everything is, but why we're invested in these assets and what we're trying to do with them over time and whatnot. And an awful lot of times, their spouse and their kids aren't really very involved. They're very appreciative of the role that person's playing, but they're busy doing their other stuff, right? And so the financial quarterback, kind of gets the realization of like, oh my gosh, if I got like hit by a bus tomorrow, I don't know what my family would do. I don't know who would kind of take the torch from me. I think it would be really disruptive. I think they'd have a lot of anxiety and panic around this. And as you guys have seen as capital managers, what very much happens then is the people who kind of get the responsibility dumped on them and don't feel that they know how to shoulder that responsibility. They start making really emotional driven decisions. Oftentimes they can get kind of taken advantage of by some bad actors in the financial industry that kind of like to prey on people like that. Oh, hey, don't worry, I'm going to take care of you, right? And they kind of get fleeced. And so my question is how do you guys help people avoid that fate, right? Because there's plenty of things you can do in the here and now to try to either get the other family members plugged in, either as active people and help them learn how to take over what you're doing, or I'm going to guess probably more commonly, the financial quarterback finds a professional to play the role as quarterback and say, hey, look, at some point, if I'm not around, my family should work with you. Let's start a relationship. Let's make sure that my wife knows who you are, or my kids know who you are, or whatever, so that if I all of a sudden am not here, they're not starting cold turkey. They know that somebody already knows the family, knows our needs, has a playbook that we were comfortable with, and can just continue taking care of them. So how do you help people avoid that fate, like I said, of the key quarterback, suddenly getting knocked out of the picture and not having the family scramble and get taken advantage of possibly?
I'll try to answer that question briefly. I think you asked me to keep it to 60 seconds, so I'll try.
Well,
It's
I'll give you a couple. I'll give you 3 minutes.
okay. I think I can do it in 60. We'll see. It's a common concern. We're often encountering these people where the quarterback has been very engaged and active their whole life, but is getting older now. Sometimes 80 years old or more, and they're still sharp and on the ball, but they're starting to worry about their own mortality, as we all should. Let's not forget that you can't take it with you. And there are things more important than money, but money does give people security, gives them food, shelter, clothing, and that kind of thing. So essentially what you want to do is make sure that your loved ones have some kind of passive income stream. And there's a number of ways that you can do that, or you can create that. Let me try to rattle some off. Number one, you can build a portfolio of income properties, assuming that those income properties will spin off income after your death. Some people go that way, knowing that they can always hire a manager to manage those properties. Others will buy an annuity from an insurance company. One of the most famous examples I can think of, and when I read the book Reminiscences of a Stock Operator, Jesse Livermore was one of the greatest traders of all time. Yet he made and lost 3 fortunes. Before he lost his third one, he took some portion of money and he bought an annuity from an insurance company, knowing that his spouse would always be taken care of. That's an option. You are taking the risk of putting your faith in an insurance company under that example, but that works. Anything that works to give you peace of mind can work. You could buy a basket of dividend stocks. The problem is with today's ridiculous valuations, you can't really be sure that the market's not going to collapse. You could buy a 30-year treasury bond. Not a terrible idea.
Right.
You can
You,
buy
you could you could build an income factory like Stephen Bavaria has shown on this channel. Right? Yeah.
absolutely. And you could even, Stephen Bavaria came out with, and I think that his income factory requires a little more work than pure passive, but something between a guaranteed, a treasury bond ladder and Stephen Bavaria's income factory could work. Something that targets 5 or 6% long-term returns. You can mix in some corporates, high quality stuff like that. And at least then you could be sure that for the next 20 years, your family would be okay. You could buy some gold and tell your family to sell a little bit of that as time goes by. But it's difficult. The best thing is a diversified approach. And lastly, I would say have a professional work with you that can adapt to the changes in situation. Here in New Harbor, we've got a team that I think, not perfect, but I think is pretty good at adapting to the situations that we see coming down the pike. And I think that's a pretty good dynamic approach. I know that sounds a little self-serving, but I have confidence in our team here and what we can do for people because we don't know what the future is gonna bring. Now, the key though is to find somebody good that sees things the way that you see them. Just passively putting your money in the S&P 500 or passively putting your faith in an advisor that does that is probably not going to work from these levels. But those are a few things that you can do. And happy to chat with anyone one-on-one about going through some of those ideas.
All right. Very well done, Mike, and very succinct. So good job. Well, look, I want to thank you guys both for hanging with me through this entire video, but also for continuing to do what I have you guys on this channel to do, which is to serve as a model for people about how a good financial advisor thinks and works, interprets what's going on in the markets and in the economy, and then, how they use that to influence their portfolio strategy, and then share with us on a weekly basis, like you guys do, the trades you're making, as things develop in real time on the ground. And to your last point there, Mike, I think most people watching these videos, unless they've got a long, successful track record as a DIY investor, really would better benefit from working with a good professional financial advisor who takes all this stuff into consideration. And so what I love having you guys on the channel here for is it gives me a chance to tell people, hey, this is what we at Thoughtful Money think a good financial advisor looks like. Work with somebody like this or better. You can find somebody better. Absolutely, go work with them. But you guys are setting what I hope is a relatively high quality standard that people should be saying, all right, whoever I work with should be at least at these guys' level, if not even better. So, all right, folks, if you are appreciative of the model that Mike and John, the team at New Harbor, set for us, as well as the other financial advisors on this who appear on this channel too, if you appreciate that, please let them know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you do want to talk to one of these financial advisors, you can do so for free. There's no commitment. It's just a free public service these guys offer. To do that, just go to thoughtfulmoney.com, fill out the short form there, and the advisors that you get matched with will be in touch with you within 24 hours or less. Just a reminder too, we've talked about a lot of, I think, important issues and important questions that regular investors like you are grappling with right now. We will get really deeply into these questions and a lot more in the upcoming Thoughtful Money Fall Online Conference on Saturday, October 19th. Love to see you there. Don't worry if you can't attend live on the 19th. We're recording the whole thing, so everybody who registers will be sent replay videos of the entire event, all the presentations, all the live Q&A sessions, as well as some bonus material. You'll get sent all of that within 24 hours or less of the event's ending. So to go register for that and lock in it's our lowest price, the low early bird price discount, which is still around. It's not going to be around for too much longer, but it's still available. Go to thoughtfulmoney.com/conference to lock that in. And just a reminder, if you're a premium subscriber to our Substack, you'll get an additional $50 off of the ticket price. All right, John and Mike, guys, thanks again. I'm really glad that we were able to do just a full deep dive with just you guys. We haven't done one of those for a while. I'm glad we got that done today. Great job. Really looking forward to seeing you guys on the program here with me next week.
Adam,
Thank you,
thanks.
Adam.
This was really fun. We look to do more, and we'll see you next week for sure.
We'll see you soon.
All right, and everybody else, thanks so much for watching.